Okay, so in today's video, I'm going to cover how to capture all of these trades, right? Whether you're over here, whether you're over here, there are so many trade opportunities in the market. So if we started from here, all the way here, plenty of trading opportunities. There's one right here, right here, right here, right here, this one, and this one, okay? Many trade opportunities here. If you went over here, it's the same exact thing, right? If we start from here, there's trade opportunities here, and there's a trade opportunity here if you know how to identify it, okay? And then there's also trade opportunity right here and right here. Many trade opportunities, even right here as well, right here as well. So what I'm going to do is show you how to identify each of these trade setups, right? Now, at the same time, I'm not going to go break down every single one of them, but I'm going to go through a few of them on how you could actually do that, okay? So in order to start, we do need to know a few things. So we do need to know what a fair value gap is, right? I'm not going to go in detail about what a fair value gap is in full detail. I think you should watch a video on that. But if you look at a fair value gap, it's simply a 3-candle pattern where you have a gap in between the first candle and the third candle. So for example, right here, this would be 1, this would be 2, and this would be 3, right? And so we can see right here, it's the gap between the first and the third candle. So from here to here, this would be known as your fair value gap, okay? In other words, the FVG, right? And this is usually in my on my chart, I like to label it as purple, but that's also entirely preference, right? So fair value gap. Now fair value gap is also down here, where you see 1 candle, 2 candle, 3 candles, right? Remember, it's the gap between the first and the third one. So right here, this would be your fair value gap. Okay, so you do need to know what a fair value gap is. You need to know what an order block is. Now order blocks are not that hard to identify. They're pretty much the opposite color candle before a big move. So for example, if we look let's go in a 4-hour time frame, or 1-hour time frame. Shit, I'm gonna get rid of all this so I can show you. So an order block is kind of like this right here. You have this opposite color candle before the big move, and this becomes your order block. Now specifically, a lot of people, depending on the strategy you use, they might not consider this an order block. So what I like to use is the word demand, okay? And I usually use a blue box for that, or you could just use a green box showing an area of support. And we can see right here the price touches our demand and then immediately goes back up, right? And then we can see right here, we also have a fair value gap right here that gets tapped. And once it gets tapped, it immediately shoots up, right? So we can see right here, price goes up. Right here, the price touches the fair value gap and it goes up, right? So you do need to know what fair value gap is and order blocks. Yeah, fair value gaps and order blocks, or in other words, demand, right? So this is a fair value gap. Now, a lot of people don't know how to use fair value gaps properly. I'm also going to cover that because I think it's important. So fair value gap, demand. By the way, this is a very big fair value gap, but I'm going to go back to this later. You also need to understand how to identify liquidity. So when we are looking at a market, the market can either go up like this, right? It's what we call an uptrend, or the market can go down where it's, obviously it's trending down. We call this a downtrend. And the biggest difference between the left side and the right side, besides the fact it's an uptrend and downtrend, is the characteristics of that uptrend. So when you have an uptrend, you usually are going to have, what you have is a high, and then you're going to have something called a higher high, which is basically price making a high that's higher than the previous one, right? Higher, okay, so I confused this. Higher high, right? And then you're also going to have what we call is low, and then you have higher low, okay? So this is the biggest difference, right? Now, this is really important not that you know this, because I'm going to go back to this as well with this strategy. So when you have a downtrend, you're going to have a high, or you're going to have a lower high, I should say. Lower highs, and then you're also going to have what we call lower lows, right? Just like that. Let me take this. So the market's either going to be trending up or trending down, or there's going to be times where the market is going sideways, right? So it might look something like this. It might be a little choppy, okay? So it's really important that we understand each of these. So remember, an uptrend has high, higher high, low, higher low. The downtrend has lower highs, lower lows, right? And then when you have a ranging market, usually what's going to happen is you're going to have relatively equal highs. Equal highs, okay? Which pretty much just means that there's no high that's significantly higher than the other. And same thing for the lows. You're gonna have equal lows. Now when you have equal lows, the lows are not equal, like it's just every time it touches it bounces. There's gonna be times where you have price going slightly lower, or it might even just go a little above it and not even touch this line, right? So it's relatively equal lows, relatively equal highs, okay? Now the reason why it's important that you understand this structure is because that's how we're going to approach this the markets, right? Is utilizing market structure. Okay, so for example, right here we can clearly see we have an uptrend right here. Right, so I'm gonna go through a few other ones. So this would be an uptrend, right? Obviously right here we also have a downtrend, so we're gonna talk about that one as well. So right here we have a downtrend. Okay, now depending on how you look at this, it might be different. So this looks like an uptrend here, a downtrend here, but if you actually just look at it from this point of view, it looks like a big range, right? And what we call this is a trading range. Okay, so when you have a trading range, usually what happens is we usually like to buy at the bottom of that range and we like to go short or sell at the top of that range, right? So this is just a trading range, and inside the trading range you're going to have trends, right? You're going to have an uptrend, here you have a downtrend. Okay, so I'm going to make this a little lighter because I want to work with this. Okay, so we have an uptrend here, downtrend here. Okay, and what do I mean we have an uptrend? Right here you can see that price was on a long downtrend and then it starts to make higher highs, right? So let me make that a little nicer, it looks ugly. Right, just like that, right? And then over here, price was on a uptrend. So look at the context, it's really important. Before you had an uptrend, you had a downtrend previously. Right here, before you have a downtrend, you had a mini uptrend, okay? Right, and then right here you have lower high and then lower lows, right? So this is what I mean by uptrend and downtrend, right? You see the low, higher low, high, higher high, high, lower high, and then lower lows on the bottom, right? So the reason why this is important is because it's going to help you trade using the Fibonacci retracement. So how do you use the Fibonacci retracement? When the market is trending up like this, right? The market is trending up. So what you have here is a confirmed low. Okay, and I've already talked about this in my previous video, but I'm also going to talk about it here. So here you have a confirmed low, confirmed high. And then what's going to happen is that you're going to be able to use this Fibonacci retracement tool right here. And you're going to be able to drag you're going to start from the low to the high. And what that's going to do is it's going to give you some of these numbers. Now, I recommend using my settings here, and the rest of them you can ignore, right? So you can pause the video and look at my settings, okay? And essentially what that's going to do is that price, once you have a confirmed low, confirmed high, price is going to make its way into this zone right here. Somewhere between the 0.5 and the 75. When the market is trending up, we call this a discount zone, okay? So this is our discount zone. Now, the reason why this is important is because think about it like this. Right here, the price, let's just assume the price right here is about $10 a share, right? And then up here it's like $25, right? If it's $10 down here and then I woke up tomorrow and the stock is worth $25, does it look like I want to buy it at $25 when it's higher than what it was yesterday? Probably not, right? You want to buy it when it's at a discount, right? When something goes on sale. So let's say that this sale in here, it's actually like let's say $18. Right? Or let's be more realistic, let's say $16, right? So what could happen is the price goes on sale, it's at your discount zone, price is much cheaper than it was before, so now you might tell yourself, I might actually consider buying now, right? So this is going to be your opportunity to buy, right? So right here, think of your discount zone as an opportunity to buy / go long, right? And going long essentially means you're expecting price to go up. So after hitting $16, you expect price to start going back up, right? And this price could be like 20 bucks, right? So that's pretty much what it is, right? And then if you're doing the discount or the premium, so the next one, the market has to give you a confirm high and confirm low. So I'm going to add some context to this prior. So usually when it looks like this, before you're able to apply the discount zone, the context behind the price is that it has to come from a downtrend shifting to an uptrend, all right? Going from a downtrend to an uptrend, right? I'm gonna say that again, downtrend to an uptrend. Once you have this downtrend and then you start to see price breaking out and it has a confirmed low, confirmed high, you can use the Fibonacci retracement, okay? Grab it, go from the low to the high when you're using the discount zone, right? And your goal is to buy at the discount zone. Now we're gonna add more confluences to this. I'm gonna explain what confluences are, so it makes sense. So now the context to the discount zone is that price has to be coming from a downtrend, okay? Now, what's the context when we use a premium? So the premium is obviously the opposite of the discount. So the price actually has to start trending up already prior to price, before you can start using the Fibonacci here in this situation. So for example, right here, we want something like this. So the market is trending up, it's making higher highs, higher lows, and eventually you're gonna have a high, you're gonna have a confirmed high, okay? Okay, eventually the price is going to get tired. The trend is going to start to slow down, and eventually you're going to break this trend. Okay, so if you look at this, this is what we call higher lows, right? Higher low, right? That's higher lows, higher lows, higher lows, higher highs, etc. Right? Right here, this is going to be our first confirmation of a market structure shift or a break of structure. The words are basically interchangeable. It doesn't really matter if you use whichever word. What matters here is that you understand that the price has broken that high low that formed this high. Okay, so whenever you're looking, so an example of this is like, for example, like right here. Okay, so you have higher highs, higher lows, and then right here you broke the low that created this high right here, right? So I'm gonna circle it. This low created this high right here, and then now it formed a lower low. Okay, so we're gonna go back to this. So now that you have this break of structure, what you can do is you can draw the Fibonacci retracement from this high to the low. So what's the difference between here and here? This one is low to high, this one is high to low. Okay, so essentially what happens is this is 25 bucks, right? And then the price comes down here and it's worth like, let's say $16. Okay, eventually we want to, sometimes we're going to want to go short, meaning there's going to be times where we want to trade with the trend. So here, when we were trading on this left side, we were trading with the trend, meaning the price was coming from a downtrend and then it started to go up, and we wanted to buy cheaper because we were expecting price to go all the way up to, let's say, 30 bucks, right? So that's trading with the trend because the trend is up, it's an uptrend, right? So we were expecting to buy down here at the discount to sell at 30 bucks. Now here, when the trend is going from an uptrend to a downtrend, we expect price to keep going down. So what we want to do is we want to go short at something, what we call the premium. Okay, again, the premium and the discount is going to be from the 0.5 to the 0.75 right here, 0.5 to 0.5 to the 0.75. Okay, so what that could look like is from 25 to 16, this could be like 20 bucks right here, right? So when the price reaches 20 bucks, we might be inclined to go short. Okay, so when the price makes its way here, we might feel inclined to go short with the expectation that price will go back down to, let's say, $12. Okay, so what that looks like is you open up the short position, you take a trade here, stop loss above, and then you target down here. Right over here, you're going long, which is you expecting price to go up, right? You have this opportunity to go long with the expectation that price is going to go up. Here, you have an opportunity to go short, expecting price to go down, right? So right here, opportunity to go sell, opportunity to sell slash short. Okay, so just like that, right? This might be small, I'm not even sure. Let me make it that size. So right here, so before I go further in depth, what's the biggest difference between the left side and the right side? The left side is an opportunity to go long. This setup, this structure is to go long. You're bullish, you want price to go up, and you're trying to buy at a cheap price, right? The context behind this is that price was on, the price was previously in a downtrend, and then it started to shift from a downtrend to an uptrend. So that's the biggest difference, shifting from a downtrend to an uptrend. Here, the price was on an uptrend previously, shifting to a downtrend. And so our goal is to trade with the trend, not against the trend, right? So what we're trading is basically reversal. We're trading the shift from a, up to down and down to up, right? So here it's going up and then now it's starting to go down. So we want to take this opportunity to go short, right? So remember, this is your confirm high, and then this is your confirm low right here, confirm low, okay? And once you have that confirm low, that's when you can start to use the Fibonacci. If you don't have a confirm low, you can't really use the Fib yet. So just to think about it, once the price starts to go up, then you can use this high and this low to identify the premium, right? So that's how you use the Fib. The Fib is pretty simple. It's just these three numbers right here that I specifically use to identify something called a discount and something called a premium, right? So now what we want to do is use that here, okay? So remember, this is the uptrend, so we're going to focus on this one. So this is the left one, this is the right one, and that's what we're going to do, okay? So we're going to look at it. Actually, let me keep that so we can really differentiate them. Okay, so right here, the price is on an uptrend. Looking at this information right here, the price is on an uptrend. Let's highlight that better. Yeah, so let's say right here, this is an uptrend, okay? How do we know it's an uptrend? Because the price was on a downtrend, and then now it's shifting to an uptrend. So how do you take this entry? Okay, so your goal is not to buy right here, okay? Your goal is to buy here. So what we're doing is we're identifying a confirmed low, right? Confirmed low and a confirmed high right here. This would be our confirmed high right here, okay? Confirm low, confirm high. And what we could do is use a Fibonacci retracement from this low to this high, and what that does is it gives us a discount zone, Okay. Now I'm not using this low right here. I'm using this low because this low created this high. Okay. This low created this high right here. If I zoom in, let me just make sure you understand what I'm saying. This low created this high. This low created this high right here up here. Okay. So that's all I did from this low to this high. And what I could do after I do that is identify the 0.75 to 0.5 as my discount zone. And as soon as price touches here, this is an opportunity to go long or to go, what do you call it? Yeah, it's an opportunity to go long with the expectation that price will continue higher. Okay, so this is my discount zone. I'm trying to fix my settings. Give me a second. Yeah, right here. Oh, still not working. 0.5, there it is. So somewhere between 0.5 and 0.75 is your discount zone. So if you look right here, you could have entered your trade here, stop loss below, take profit above, right? I think in a separate video I'll show you how to take profits, but for now I just want you to understand the strategy, right? So we're focusing on this information right here. This is an entry model right here. This is an opportunity to enter, right? And what you would do to enter this, by the way, is you just go in a lower time frame. So we're gonna go back to that exact right here. You go into the discount zone, look at your indicator, the RSI. If you see right here, the RSI is oversold, it actually forms a divergence. Divergence is another thing I'm going to talk about after this. But right here is your entry, okay? So this is how you would identify a long opportunity, okay? Which is this right here, right? Enters our discount and immediately goes all the way up, okay? So now what we're going to do is we're going to go on the right side and we're going to focus on a downtrend. How do we identify a premium, okay? Right here, we have a confirmed high. Okay, right here, we have a confirmed low. Okay, so what you can do is you can, remember, when we're using the template on, well, the template on the right, it's from high to low. When you're identifying discount, it's low to high. So premium is high to low, discount is low to high. So right here in this case, because it's a downtrend, we're looking for a premium. So you grab the fib retracement, go from this high to this low, and you can see right here the price right here reacts to our premium. Okay, I'm going to color code this as orange, right? And you can see right here, the price reacts to our premium zone, and then immediately it goes back down, right? So that's what that is. So let me, oops, how do I bring this here? Yeah, right here. So this is what we're focusing on. We have a confirmed high, confirmed low, okay? And then price retraces back up here into the premium and then goes back down. I'm going to delete all this after I finish explaining because I wanted to go over this one more time on how to actually take this. So remember, discount, opportunity to go long, premium, opportunity to go short, okay? So now I'm going to go more in detail about how to play this setup, right? And we're also going to go deep into this stuff right here with the demand. So let's see. This would be your short opportunity right here. Stop loss above the high, and then target this demand. Just like that, right? Let's see. That's pretty much it. I'm going to go dive into these trades more in depth right now. And the RSI, okay, so the RSI is pretty simple. Anything above 80 equals overbought, right? When it's overbought, that means it's not a good time to buy. When it's at the bottom, below 20, it's known as oversold. Pretty simple, and it means it's an opportunity to look. It's a better opportunity, or I shouldn't say opportunity, but when the RSI reading is below 20, it's usually a good time to start looking for longs. Right now, you have to pair this up with other confluences, which I'm going to show you in depth on these two trades right here and over here. Okay, so when it's overbought, it's usually not a good sign to buy because it's already overbought. And the way this indicator works is that it's kind of like price. It goes up, goes down, goes up, goes down. Right. So if it's up here, it's overbought. You want to usually wait until it comes back down here to buy. Okay. So I'm going to delete all that. That's how you use the fib. Just like that. Okay. So right here, how do we take this trade? One, you get this low to this high. You identify this discount right here. This discount right here. This is going to be our discount zone. So the way to match this up with other indicators when you're trading is once you have this high right here, right, and then you identify this discount zone, your goal from now is to look for bullish price action. Okay, so when you enter here, right, for example, let's say like right here, let's say you enter at this candle right here, right, because you have and it's oversold and you expect price to go higher. You'd enter this trade, right, somewhere inside there, and then you'd put your stop losses below these lows right here. Okay, and then what you would do is identify liquidity. So I'm also going to talk about that. This is liquidity right here. Okay, this right here. So liquidity is basically your entire chart, but I'm just going to show you liquidity. Okay, money signs equal liquidity. Fair value gaps equal liquidity. Okay. And I'm gonna put that as purple. Okay. Right here, or you don't even have to put that. You really just gotta put it right here. So these are all money signs. Okay. And essentially these money signs, so I'm gonna write it down. Money sign equals liquidity, which equals a magnet for price. Okay. But this only happens, so I'm gonna be clear. In order for these levels to be a magnet for price, the price or the structure has to shift from a downtrend to an uptrend. Okay, so right now this is from here to here. The price has been on a downtrend. You can see that, right? Right here, the price looks like it's starting to shift to an uptrend. So if it's shifting to an uptrend, it's shifting to a bullish order flow, and so we have that expectation that price will take out these people. So liquidity. Think of liquidity as traders with, or think of liquidity as positions, stop losses, early buyers, or oops, my mic died. Well, I'll just keep it on. So liquidity equals positions equals stop losses, early buyers, and late shorts. Okay, that's what liquidity is. Okay, and how to identify that is pretty much when the market is trending down. Okay, like this. These highs right here, these highs equals liquidity. Liquidity. Okay, these are the late shorts, right? These are people who open up shorts and they never closed it, or they have stop losses here. Okay, this is liquidity. So if you look right here, I identify 1, 2, all of this liquidity. Okay, so why does the price, so why is that important? Because from here, why does the price go all the way back up here? Because of liquidity. It acts as a magnet for price. Okay, so acts as a magnet for price. And then, so once price gets here and you put a stop loss, so right here we can see that price starts to take out all these people. Fair value gaps act as liquidity. Okay, so when you enter this trade, look at the RSI. Your confluences, okay, confluences are tools that align together. Okay, for example, discount plus fair value gap plus demand plus RSI oversold. This is an easy combo right here. So you don't need all of them, you just need maybe 2 or 3 of them, right? So in this case, we have a discount zone, we have the RSI at the bottom. There's other things too I can add to this, but I don't want to add too much because it will be confusing. So right here you have a discount. I should mention this is also a key level right here. So this is a lot. You're just gonna have to write down notes and really practice this. Key level right here, right? Key level is just gonna be your green box. And so if you have a combination of 2 or 3 or more, it's a high probability. Okay, so here you have the RSI is oversold. It forms a bullish divergence. So this is what I'll talk about divergence. Divergence is basically when the price is doing the opposite of the indicator. So in this case, we have an RSI indicator. This is the stochastic RSI. And so the indicator is showing us that the RSI is aiming up, but right here, the price is going down. Do you see that? It's making lower lows. Okay, this is a bullish divergence. So I'm going to show a few more examples on that, but this is a bullish divergence, discount zone. So this was a good trade opportunity right here. And every time you take trades, make sure that you have liquidity. Okay, so if you're going to take a trade, you know, down here, just make sure that you have liquidity to target right here. Okay, so if you're going to buy here, stop loss down here, make sure you can target up here. Make sure there's a high right here that you can target. So for example, if we go back to this, there's a high right here that we can target. If we buy here, there's a target. We can identify this as liquidity, so we can put our take profits right above it, right? So that's what you need to know when you're going long. Okay, now let's go back to this. Okay, let's see. Let's see. Let's go back to the 1 hour time frame. Okay, right here. Another entry model. So this is pretty simple. This is what we call liquidity sweep. I'm not going to go in depth about this, but this is what we call a liquidity sweep. Okay, liquidity sweep is pretty much price taking out a low. So it looks like this. Boom, and then goes back up. It's pretty much taking out this guy right here. So this is liquidity, and then this is the sweep, right? Liquidity sweep. So this liquidity sweep presents a good trading opportunity to go long. Okay, and you can see right here, after the liquidity sweep, the price then targets liquidity right here. Remember, money signs equals liquidity. So right here. So you can see right here, this would have been a trade opportunity right here, right? And then not only is this a liquidity sweep, but the liquidity sweep occurs at a key level. Okay, so this is going to be our demand, right? How do we know that this is demand? Just look at the amount of touches it has. Okay, you can see right here, price goes up, price goes up, price goes up. So when price sweeps liquidity, taps our demand, this is a good trading opportunity with the RSI at the bottom. I'm not going to move my mouse, but you can see right there, oversold, liquidity sweep, demand. So that's another way of entering the market. I'm not going to go too much in detail on that because it's pretty simple. It's pretty much taking out a low or taking out a high. So for example, right here, same thing. This was acting as liquidity right here, this high, right? So this high led to a downtrend, right? And then what happens is the price shifts from a downtrend to an uptrend. And so what's happening is right here, during this period right here, the sellers were in control of price. And then eventually the buyers stepped in at demand. Okay, right here in this green box, this is demand. Buyers stepped in and it shifted from a bearish order flow to a bullish order flow. So once we shifted from a bearish to bullish order flow, the price then started targeting these highs right here. So these highs right here also act as liquidity. Okay, so in order for us to take a trade, we want to be able to identify liquidity. So right here, this also would have been a good trading opportunity, targeting above this high right here. Okay, so after this liquidity has been tapped, right, and right here, let me show you, RSI overbought. I'm not going to open up the RSI yet just to show you RSI overbought right here, RSI oversold. Right, let's delete that. Delete that. Delete that. Oops. All right. So RSI overbought, RSI oversold. After the price after the price sweeps above, right, so right here, price sweeps this high, what ends up happening is, since the price reversed back down, this is what we're going to call a liquidity sweep. Okay, so when you have a liquidity sweep, the price should start to reverse in the opposite direction. So in here it went up, right here it went down. Okay, this is a good example. So right here you have a high, I think we talked about this, we have a high, we have a low. This is our premium zone, right? Premium zone. Okay, right here we have a bullish trend. So right here we actually, before I even do this, I'm just going to show you guys, when you have a strong uptrend, so when you have a, I'm going to repeat this, if you have a really strong uptrend, the price is going to react to 382. I personally don't use it, but it does react to it very well. So you can have all four of these if you, or at least three if you want, entirely preference. But right here we have a confirm low, confirm high, so what we could do is drag it from up here to this low, and we see right here price reacts to the 0.5 pretty nicely with the RSI oversold. So this would have been another trade opportunity right here. Stop loss, I would say down here, and you have all this liquidity right here. This is what we call equal highs, if you guys remember, if you remember from the beginning of the video. Equal highs. Okay, this is equal highs. Right here you have fair value gap. Right. Let me change the color on this. So what you could do in this situation is, if you enter this trade, you can target above the equal highs because you know that price is going to sweep above it. And right here you have a little supply zone, okay, or an order block, I should say. And then right here you have the fair value gap. So you can target one of these here, here, or even here. Okay. So what else do we have here? Oh, I think I forgot to mention the RSI overbought right here. Yeah, you see right here the RSI is overbought right here. RSI is oversold. Let me circle that right here, and then right here. So these two circles represent a trade opportunity. Here is a trade to go short. Here is a trade to go long, right? So I'm trying to show you guys all the possible trades within this range. Stop loss above this high, and then target demand. So you have 1, 2, 3, 4, right? And then obviously you have these two that I mentioned early in the video, right? So looking at this, so I'm just marking up my chart now so you can really get a grasp of how to identify things. Right here, you have these highs right here. These highs right here also act as liquidity. Okay, so up here, this is liquidity. Okay, so what does that mean? That price is going to want to make its way up here as well, and we see it does it right here, right? So right here, also liquidity. The entire chart is liquidity. You just have to be able to identify it properly in a way that makes sense towards your trade, right? So if the price was down here, there's all this liquidity up here. It makes sense why the price starts to go back up, right? The same thing over here. This is all liquidity right here. this is, oops, this is liquidity, okay? And we can see right here on the right side why the price ends up going down here. It's because you have a lot of liquidity down here. And then these lows right here also act as liquidity, right? So why is it that the price goes all the way down here? Because there's liquidity down here. So from up here to down here, it was just taking out these people from earlier, okay? This is, I don't even know how long this video is. This is a long ass video, I won't even lie to you. But let's see, right here, this is another example of a good trader here. This one's a little tricky because this one had a long ass sweep. But what you can do is grab the Fibonacci from this high to this low, and then you can see that the price went all the way up here, but it closed down here. So this is also still considered respecting the premium, okay? So this is still going to be our premium, okay? And just like that. And then you could take the trade. You don't take the trade as soon as the price touches premium. You touches it as you start to see bearish price action. So right here, stop loss above these highs, and then target the liquidity down here, right? And then right here, you're just going to have this opposite color candle before the big move up, if you see that. So this would be an example of an order block, which is opposite color candle before big move, right? So this would be a green box, something like that, right? Let's see, what else is there? Here, right here, I'm trying to cover as much as I can. Supply zone. Supply zone is pretty much an order block. It's the opposite color candle before big move. So this would be represented as a red box, and we can see right here that this is the opposite color candle right here. Right, the price going down, that you have this opposite color candle where the price stalls for a little bit and then it goes back down. So this is going to be a supply zone. This is also going to act as a magnet for price, right? So let me write this. This is demand, which is an order block, opposite color candle, right? Demand zone, which is also a magnet for price, okay? So I'm trying to see how to make this okay, something like that, right? And I'm just gonna show you, it's literally this candle right here and then this candle right here, right? That's what we call an order block. Fair value gap, again, is just a 3 consecutive candle, 1, 2, 3. The gap is in between the first and the third. Let's see. Okay, divergence, another way to identify divergence. When the market is trending up for a long ass time, eventually it's going to get tired and exhausted, and it's going to form what we call a divergence, right? And it's going to look something like this. It's pretty much the price makes higher high, oops, higher high, yeah, which is a bearish divergence, okay? Put that up here. Price makes higher high is a bearish divergence, and then on the indicator makes lower high, that's a bearish divergence, right? So for example, right here we can see that the price makes higher highs, and then right here the indicator makes a lower high. If you see it right here, it's kind of hard to see. Higher high in price, lower high in the indicator. See, this is a high, this is lower high, this is a high, higher high. That's what a divergence is, and it's basically telling us that the trend is weakening and it's starting to slow down. So from here to here, you have an uptrend, okay? And when you have this divergence that forms, this is a divergence, okay? Divergence. This is a signal for weakness in the trend, loss of momentum. So when you have a divergence, you have a signal of weakness, which is showing you that there's potentially a loss of momentum, okay? And that's why the price starts to go back down here. So I'm actually going to go through this because this is a trade that recently happened that I was talking about in the Discord. So right here you have a divergence, right? And so what you're waiting for, before you play the divergence, what you want to see is higher highs, right? This is uptrend, and then this divergence, and then you want to see this play out. And this is pretty much going back to the Fibonacci where you have a confirmed low, and then you have a confirmed high, right? Confirm high, confirm low. And what you do is you drag the Fibonacci from this high to this low, and it's going to give you a premium zone. So from right here, this is going to be known as your premium. I usually use the orange box. So here you have a premium. And remember, if you remember, when you have a premium, you're going to look for, opportunity. I can't even spell opportunity to go short or sell, right? Opportunity, there it is, right? Look for opportunity to go short or sell. So what does that mean? You're gonna look for the short position tool, and then you're gonna do something like this, right? And so when the price makes its way back up here, boom, boom, and then just like that. That's all you're waiting for, right? And that's exactly what happens here. You have a confirm high right here, confirm low, and then the price makes its way to the premium right here, and then the RSI should be overbought. So let me write that down over here. RS overbought RSI. Okay, so if you're going in the premium, you're looking for a short opportunity, the RSI should be overbought. Vice versa, if this was a downtrend, or if this was the discount zone, the RSI should be oversold, right? So just like that, you could have taken this trade opportunity here, stop loss above these highs, target, liquidity. Right here, you have a massive fair value gap, which is where the price ends up going to, right? It's a lot of information in one trade, one video. It's like a 50-minute video. I'm trying to think of what else is there. Honestly, I'm just going through every chart to really mess around here. Right here, simple right here. You have a high, you have a high, you have a low. Right here, short opportunity. What's the context before the price goes up? The price was on a uptrend, and then it shifts to a downtrend, right? So if you look at it, uptrend during this entire period, and they go from, you have a break of structure, retracement, a pullback into the premium, and then price goes down. Right, so confirm high, confirm low, boom. Right. Remember, how do you identify whether, the context is price is going from an uptrend, right? And these are all higher lows, and then once price takes out the higher low, for example right here, then you can start to look for a premium. So this has to happen right here. Okay, and then even if it goes all the way down here, that doesn't matter. You need this confirm high, confirm low, and then boom. And then you look for a short opportunity back down, right? Pretty simple. This is how you use the fib. I'm going over it multiple times so it really sticks. If the price is on a downtrend, boom, right? When the price starts to go back up, wait, oops, bad drawing, delete that. How do I get rid of this? There it is. So let's say the price is on a downtrend. I'm trying to make it as realistic as possible. Okay, right here, as soon as you have this break of structure right here, remember this is low, lower low, lower low, lower high, lower high, lower high. Once you have this, once you take out the previous lower high, now you have a confirm break of structure, and then what happens is price is going to retrace. You're going to grab the fib from this low to this high, and then you're going to enter a trade inside here, expecting price to go up, right? So it looks something like this. And then right here, you can see that there's a imbalance in price. Maybe there's a fair value gap right here, right? Fair value gap. And just like that, this is how you take the trade. So this would be your break of structure. Okay, same thing down here, break of structure, right? Boom. Okay, now I know something I forgot. When you have a, what do you call it? Sometimes what's going to happen with the premium and the discount is sometimes you might have a fair value gap in it. Okay, so I didn't really talk about this. So it's kind of like right here. Let's show you what I'm talking about. Replay. We're going to go, oh shit, what did I just do? Okay, so right here, for example, right here you have a fair value gap right here. And then what happens? You also have your discount zone right here. Discount zone, okay? And then you have a 1 hour FVG. So this is actually really good. So sometimes you're gonna have, there's gonna be a time where the price aligns with both of them. So you're gonna have two of them at the same time. This is actually a good trade opportunity. So you wanna take trades when it touches your gap, or when you have a gap in a discount zone. So when you have two overlapping each other, that's pretty good, right? Same thing right here. You have a bearish fair value gap, and then this is also your premium, right? So remember, this is the gap, this is your premium, and they're overlapping each other. So this is a strong signal to go short. stop loss above, and then target all the way down here into these imbalances, right? So when you're looking at it, if you remember, I said or I don't even know where it's at, right here. Yeah, so at the premium, the R side should be overbought. So if we go back to that example over here, let's see. I don't even know where it's at. It's right here. Yeah, it's over here. So right here, this is your. If you look at the RSI, it's overbought. Overbought. It's inside of a bearish fair value gap, inside of the premium. It's overbought. So this is a short opportunity right here, right? And then if you look at it, you have all this liquidity right here. So going back to it, you have liquidity right here. Okay, so this is a good trade opportunity because now you have liquidity, and then you have all of this imbalances right here. Imbalance in price. Imbalance in price or FVGs, right? So now you know that price is going to want to come back in here at some point in time. And just like that, right? Hopefully that makes sense. I feel like this video is probably already too long. Another thing, I guess, let me see. I think that's pretty much it. I don't think there's anything much more. If there's anything to really understand, it's this right here, this screenshot. This right here. This is all you need right here. So break of structure, enter the fair value gap. Right here, break of structure, enter the premium. This could also be a fair value gap, by the way. Premium plus fair value gap. So it can definitely be both. Right here, discount plus FVG. It's not every time it's going to be that way, but sometimes it is going to be that way. And usually if you have both of them, that's pretty strong. So just like that. This is all you got to study right here, really. And look at the big, just understand the context before price does this. Came from an uptrend, this one came from a downtrend, right?